You don't need a genius-level IQ to build wealth. In fact, trying to outsmart the market often backfires over time. Today, we're breaking down 7 reasons why ordinary, consistent habits can create extraordinary wealth, supported by real U.S. economic data. We're going to dismantle the myth that you need to be a financial genius to succeed. If you're ready to learn strategies that actually work, hit that subscribe button and turn on notifications. Let's dive into the data. Reason number 1, the debt trap of overconfidence. We often assume that if someone can solve complex equations or memorize historical facts, they can manage money. But the data tells a different story. Jay Zagorski, a researcher at Ohio State University, tracked thousands of Americans, comparing IQ scores with net worth and financial distress. His findings: higher IQ was linked to slightly higher income, about $200 to $600 more per year per IQ point, but it had almost no correlation with wealth accumulation. Even more surprisingly, people with higher IQs were slightly more likely to max out credit cards or file for bankruptcy. Why? Overconfidence. Many believe they can use complex strategies and leverage to get ahead, but this often increases risk. Ordinary investors, however, often treat debt with caution. They see it as a risk, not an opportunity. They focus on cash flow and survival. This mindset helps them avoid the leverage traps that can wipe out even high earners during downturns. Reason number 2, the cost of complexity. The financial industry thrives on complexity. Sophisticated-sounding investments, hedge funds, derivatives, private equity, often attract smart investors, but complexity usually comes with high fees. For example, actively managed funds may charge 1.5 to 2% annually. A simple S&P 500 index fund charges around 0.03%. Over 30 years, $100,000 invested at 8% growth, a low-cost index fund is about $1 million. A high-fee fund is about $660,000. That's a $340,000 difference, largely due to fees. Ordinary investors who keep it simple often keep more of their returns. The lesson? In investing, you don't always get what you pay for. You get what you don't pay for: low fees, compounding, and simplicity. Reason number 3, the lifestyle trap. Cars. According to 2024-2025 data from Edmunds and Experian, the average monthly payment for a new car in the U.S. is about $745, with many luxury buyers paying over $1,000. High-income professionals often justify these purchases because they can afford the payment. But cars depreciate quickly. An ordinary wealth builder asks, is this asset growing my money? Driving a reliable used car and investing the difference can mean hundreds of thousands saved over a decade. Over 10 years, $1,000 a month invested at 8% becomes about $182,000. The car, meanwhile, becomes a depreciated asset worth maybe $15,000. One bought status, the other built lasting freedom. We're uncovering the habits that separate the wealthy from the broke. If you're finding value in this deep dive, hit that like button. It helps us reach more people ready to build real wealth. Reason number 4, the behavior gap. Dalbar study. You might have the highest IQ in the room, but if you cannot control your emotions, you will lose money. The biggest challenge for investors isn't the market, it's their own emotions. The research firm Dalbar publishes a famous study called The Quantitative Analysis of Investor Behavior. Year after year, it shows the same tragedy. The average investor significantly underperforms the market index. For example, in 2024, the S&P 500 returned over 25%, while the average equity investor earned about 16%, showing a gap of nearly 9%. Why? Because smart people try to time the market. They read the news, they analyze economic data, and they think they know when to sell before a crash and when to buy before a boom. They sell in fear and buy in greed, exactly the opposite of what builds wealth. Ordinary investors who automate contributions, dollar-cost averaging, avoid emotional mistakes. By staying consistent, they capture the full market return. Their discipline protects them from the behavioral errors that erode returns. Reason number 5. The janitor versus the executive. This isn't just theory, it's history. Let's look at the famous case of Ronald Read. Ronald Read was a gas station attendant and a janitor in Vermont. He wore flannel shirts and used safety pins to hold his coat together. He didn't have a high IQ, and he certainly didn't have a high income. But when he died in 2014, he left behind an estate worth about $8 million. How? He bought stocks in high-quality U.S. companies like Procter & Gamble and J.P. Morgan, reinvested the dividends, and never sold. He held them for decades. Contrast this with Richard Fuscone. Fuscone was a Harvard-educated MBA, a Merrill Lynch executive who retired in his 40s to a massive mansion with 11 bathrooms. He was smart, but he borrowed heavily to expand his mansion and leveraged his investments. When the 2008 financial crisis hit, his leverage crushed him. He filed for bankruptcy, and the bank foreclosed on his home. Ronald Read practiced patience. Richard Fuscone took on excessive risk. In the game of wealth, patience consistently outperforms intelligence alone. Reason number 6. The power of enough. There is a psychological trap that highly intelligent, high-achieving people fall into. The goalpost keeps moving. When you are smart and ambitious, you're wired to optimize. If you make $100,000, you want $200,000. If you get a 10% return, you want 15%. This constant need for more leads to excessive risk-taking. It pushes people into speculative crypto plays, high-leverage real estate deals, or complex business ventures that eventually blow up. The ordinary investor often has a superpower, the concept of enough. They define their financial freedom number, say $2 million. Once they hit a trajectory that gets them there, they don't swing for the fences. They stay the course. They prioritize peace of mind over constant optimization. Understanding enough prevents you from risking what you have and need for what you don't have and don't need. It is the ultimate risk management strategy, and it requires humility, not intelligence. Reason number 7. The strength of consistency. Finally, let's talk about the mechanics of the ordinary investor's success, the S&P 500. The S&P 500 represents the largest U.S. companies. It evolves naturally. Weak companies drop out, strong ones enter. Warren Buffett himself instructed that most of his family's inheritance be placed in a low-cost S&P 500 index fund. Ordinary investors who stay consistent with such strategies often outperform those who constantly chase smarter opportunities. Consistency is the most underrated variable in the wealth equation. You don't need brilliance, you need consistency sustained over decades. Wealth isn't about IQ, it's about behavior. Avoid risky debt, keep investments simple and low cost, don't confuse status with success, control emotions instead of timing markets, learn from patient investors like Ronald Read, define enough to protect your freedom, stay consistent with proven strategies. Master these habits, and you'll greatly improve your odds of building lasting wealth. I'm curious to hear from you. Do you know someone who's book smart but struggles with money? What's one simple financial habit you're committing to this year? Drop your answers in the comments and subscribe for more educational content on personal finance.